I've been very surprised by how fast the industry developed and how much money has come into the industry in spite of the returns in the 90s, which were particularly bad, and the early 2000s. I think the industry has figured out how to do it much better than the initial 20 years, where people were examining a strategy and it failed, or examining a country or an industry and found that that wasn't the right one. There was a great deal of learning in the 70s, 80s, and 90s, and some of the major learning has happened.
From where we started in '99 on whether private equity makes sense in Asia, to whether buyout is a sustainable industry, whether you can find enough deal flow after restructuring is done, to whether you can get leverage, acquisition finance, to post 2005, no one questioned that. So the whole intermediary network has grown up. There are a lot more evidence of success, landmark deals in the buyout industry across Asia, not just Japan, Australia. You have in Hong Kong, Taiwan, Greater China, Southeast Asia. So I would, if I look back at my first assessment, I think it has exceeded expectation in that sense. Whether the return, so the industry has really grown. Now return is a different question. I think it is arguable whether if you do a buyout deal in Asia, whether you necessarily should be asking for a higher return than if you do one in North America. I think that remains a question.
Well, I think everybody in the industry has been surprised. I mean, even the most optimistic of us, I think, would have to admit that things really ramped up dramatically in the 2000s, possibly more rapidly than the market was capable of absorbing. But that was a real explosion of activity prior to the crisis. There was just a lot of money in the world looking for things to do, a lot of enthusiasm, a lot of exuberance, and fund managers were created very rapidly. I think that was a surprise. And a lot of money was made, but the dispersion of returns is pretty broad, so not everyone did so well. And I think that what we're seeing now, 10 years later, post-crisis, is some of the chickens are coming home to roost as far as some of the funds that were formed without really careful analysis or careful structuring or the right composition. Sector issues, concerns about exits are becoming very, very prominent now. I mean, Asian private equity is a broad term. I always say, it's a geography, not a market. And so, I think clearly there are, places where people have made significant returns on their capital. And I think private equity plays an outsized role for funding private companies in China. It still does, has significantly over the last 10 years. And there, if you invested wisely or were lucky or a combination of the two, you could have done extremely well. I think, that we hold up in terms of the overall performance very well vis-a-vis the US and Europe if you're in the top quartile.
It's become very competitive, and I think the sources of capital have become, the industry has grown up at a time when the capital pouring into the private equity industry has also increased dramatically. So we had a huge increase in fund sizes in Europe and North America in the 2000s, and a big expansion of the limited partnership pool around the world as not only asset allocations among traditional investors increased towards alternative assets, but whole new pools of investors were created. Sovereign wealth funds all over the world, the large Canadian plans. So you had this huge influx of capital at a time when the industry was also was maturing here in Asia and developing local players. And Asia is a very entrepreneurial place, and anyone who's really good and establish themselves as a private equity investor is inclined to go off and set up their own firm. So you have this confluence of regional firms, global firms, local firms, all competing in each of these markets.
If you look at the deal size, it has become much larger than before. And I think if you look at the competition, we were quite lonely at the time in the late 1990s. And now there's a lot of capital, a lot of private equity capital around. So I think that the market has become more familiar with private equity as well. I think it's a process of market selecting the best managers, because I don't believe that the market can have so many competitors. And our business is how much money you make for investors. And I think over time there will be differentiation. The best managers will stay, and not so good managers probably will have to exit. Although in this business, it takes a long time for somebody to exit.
You have, I think, a thriving private equity industry where we are proving the thesis that you can make money doing buyouts in Asia. The markets in Asia, to be sure, have developed at different rates. In the markets that I operate in North Asia, that is China, Japan, Korea, I think certainly buyouts have been proved, and in those markets, I think private equity in general is a buoyant industry. Certainly the economy, the gravity, center of gravity of the economy has shifted, and with that, with demographics, with rapid corporate expansion, and liquidity in both the credit and equity markets, particularly private equity markets, I think Asia is now a very important market, and certainly is holding its own as the third leg in the US, Western Europe, Asia tripod for private equity.
I think for us, we are very, very happy with the growth of our private equity business in Asia. It is by far the fastest growing part of our global private markets business today. We've reached a scale in Asia with Asia 3 at $9.3 billion, where we believe we are competitive across every one of the key markets that we're trying to do business in. From a return standpoint, we've generated very strong returns in the last decade. We've invested over $12 billion of capital in around 60 transactions. And at least within the KKR world, Asia has delivered the highest returns within private equity in Asia versus the US and Europe in the last decade for us. I don't think we could have ever predicted how quickly the business would scale for us in Asia. But when you think about the scale of the economies that we're addressing, with China, with Japan, India, Indonesia, Australia, Korea, these are some of the largest markets in the world in terms of GDPs. So when you think about a $9 billion fund in that context, it's not that challenging in terms of putting that money to work. I think what's really hard, though, is being disciplined and being flexible and being the partner of choice in this market, because we're not looking to build market share per se. We want to do a handful of very, very significant transactions in each of these markets and be very disciplined about how we deploy that capital today.
Asia has proved itself, but it hasn't, not all of the impediments have been removed. We still may have currency issues. We still may have government stability issues. We have better access now to exits than we did 30 years ago, so that's good. We have more experience now both in the hands of entrepreneurs and in the hands of general partners of funds than we had 30 years ago. So there are a lot of positives that have occurred, but still Asia is more likely to be perhaps more cyclical than the US, for example, and certain other parts of the world. So that's something we all have to put up with. But even in the US, if you look at the private equity business over 30 or 40 years, it is a cyclical business. And in fact, most investment businesses are cyclical. And so we have to expect that both here and in Asia. It may be subject to different variables in Asia than it is here. But clearly this is a market that is here to stay. And as we all look at China's growth and the potential in China, if we are not all invested in China, we're missing a market that is probably going to be one of the biggest markets in the world, and maybe someday may even eclipse the U.S. private equity market.
Today, the industry, as we look at it, basically mirror what we have seen in the U.S. and Europe. Right? We look at also the measures of data, transactions, and number of players and penetration, we like to compare ourselves with US and Europe. And I think we're obviously not there yet, so there's still a lot of growth to go. But I think with the emergence of China being a very important market and private equity being very, very vibrant in China, and China is, I think, experimenting with a different model with unique characteristic. I think Asia will go down the same path. We will have more unique Asia characteristic. For example, the participations of sovereign wealth funds, state-related entities, not just at the LP but also at the transactions level. I think that will be a lot more common in Asia than in US and Europe.
We have a significant amount of domestic capital now playing, particularly in China, but elsewhere in the region as well, but particularly in China. And the dynamic there is changing, and it's clearly the case that there's a lot of money, I don't know if trapped in the system is the right word to use, but there's a lot of money staying within China that's looking for things to do, and maybe they're doing things in a different way than what our traditional private equity managers would do. The durations tend to be shorter, they tend to be taking more risk and quite aggressively pricing assets. So I think that's changed a bit. I think that will normalize over time. I believe that anyway. I believe that the kind of capital finds its own level globally, but it may take longer than we expect. And that changes behaviors and it changes expectations.